Tax tariffs have long played a pivotal role in shaping global trade and the economic dynamics of nations. These taxes, imposed on imported or exported goods, serve as both a revenue source for governments and a policy tool to regulate trade. The concept of tax tariffs is deeply intertwined with the principles of protectionism, free trade, and economic diplomacy, influencing the competitive landscape of industries, the flow of goods, and the relations between trading nations. At their core, tax tariffs are designed to create a structured economic environment by balancing the interests of domestic industries and international trade partners. When a government imposes tariffs on imported goods, it can protect local businesses from foreign competition by making imported products more expensive in the domestic market. This protectionist approach aims to shield nascent or struggling industries from being overshadowed by established international players. However, while tariffs may offer temporary relief to local industries, they can also lead to reduced competition, higher prices for consumers, and potential inefficiencies within the protected sectors. The impact of tariffs extends beyond borders, often triggering a domino effect in international trade relations. When one country imposes tariffs on imports, trading partners may retaliate by implementing their own tariffs, leading to what is commonly referred to as a trade war. These conflicts can disrupt global supply chains, increase costs for businesses, and create uncertainty in the market. On the other hand, tariffs can also be used as a negotiation tool in trade agreements, encouraging countries to reach mutually beneficial arrangements that reduce trade barriers and promote economic cooperation. The revenue generated from tariffs is a significant aspect of their function, particularly for developing nations. For countries with limited domestic tax infrastructure, tariffs provide a reliable source of income that can be used to fund public services and infrastructure projects. However, an over-reliance on tariff revenue can have unintended consequences, such as discouraging trade and investment or fostering illicit practices like smuggling to evade taxes. Striking a balance between revenue generation and fostering a vibrant trade environment is a complex but essential task for policymakers.